right, today is February 26th, and for the contract class today, I am choosing to talk about the financing contingency. So I'm going to be referring to Form 22A. Technically, it's called the financing addendum. So with the financing addendum, the things I hope to talk about in this Zoom are going to be, one, why we use the form. What are the consequences of using it? Do you have to use it? And how do you leverage this form to protect your buyer or your seller, depending on who you represent? And then towards the end, we'll be discussing situations and how it relates to the form. There's a lot that goes on with this form. In fact, it's one of the most important ones that we put into the contract, and knowing how to use it is an absolute must. So here is the form in its entirety. It's 3 pages long. And what you are doing when you put this into a contract is you are making an agreement that is contingent on the terms that you choose in this form. This addendum is a promise for the buyer to make application for the loan that they have identified with the down payment that they've noted in the time that they've promised. For the buyer's good faith, their earnest money is protected if that application fails to close in the sale. So what is the difference between financing addendum and evidence of funds? Well, in both situations, you could use these to disclose that the buyer has a loan that they need to use. And both of them have a clause in there that allows a lender to conduct any needed inspections, and has some of those basic protections. But the main difference between the two of these is that the financing addendum is a contingency protection, and the evidence of funds is a disclosure. So like I said, the financing creates the contingency, and the other one just discloses where the funds are coming from. So keep in mind, the reason we do this is because all contracts assume the money for the sale is going to be cash, non-contingent, unless it's otherwise disclosed. And it's our duty as agents to disclose where all money is coming from in this purchase. If you happen to use a 22EF, make sure you are not disclosing the financing on the 22EF and the 22A. You have to choose one of those two, because you're either going to create a protection for it, or you're just going to disclose that that is what the buyer intends to do. So let's talk about how to fill this out and why it's important when we write the things we write. Here's the 22A. The first 4 lines are going to be dated and aligned with the contract that we are in. These 4 lines reference the purchase and sale agreement. So remember, that dated line that you have on the top of all of your forms is not going to be mutual acceptance necessarily. It's going to be the date the contract was written. And then you want to make sure you're also identifying the buyer and seller and the property so you can keep it with the contract it belongs. The paragraph 1 talks about the loan application. When you check these boxes, that is when the contingency is created. So before you even start pulling this form out, you need to have a conversation with your buyer and find out how they intend to pay and where all of the money is coming from. When you select one of the boxes, what you're doing is you're making a promise to that seller that your buyer is going to fill out that specific type of application. So you need to make sure that the things you put in there are the applications the buyer is actually doing. Now, we are in a market where typically a buyer comes to the table at the very minimum with a pre-approval letter, which should state what kind of loan they'll be using. If you check conventional first, that buyer has to apply for a conventional first mortgage. Now, it is possible that the buyer could maybe have their hands in a couple different types of loans, maybe a couple different types of approvals. But in order for this contingency to protect that buyer, the loan checked on this box needs to be the one that matches their application. If you are using a home equity line of credit, this is also another place to put this. And all of these things are technically considered contingent funds. So a home equity line of credit is still going to rely on an approval from the bank and potentially an outside appraisal for a completely different property beyond this sale. So it's only fair that that seller knows where the money is coming from. If you happen to be using a government down payment assistance program, those also require an application and they need to be approved. So there's a space to do that on the financing addendum if you intend to have your buyer protected under this contingency. I'm not quite sure what you could put in the other category, but I'm sure there are reasons and other types of loans that are not listed on here. Just try to be as specific as possible. Next is going to be your down payment. Now, this is the down payment that your buyer has to apply with. So if they say they're going to put a dollar amount of, $100,000 down, then that is what they have to make application for. And same with the percentage. If they're putting the percentage down, they need to be able to go ahead and get approved with that percent. Now, if they think maybe they want to put more down later, I would highly recommend doing what minimum is required by that loan so you can make sure that they are approved and then have the choice to add more to their down payment later. If you put something like 25 or 30% down here, but the loan only requires 10% down, they need to make sure that when they apply that they truly do have the money for that 30% down. As a seller receiving an offer that has a large down payment, you may want to be asking yourself or your client, obviously your client too, do they have the money to put down in this space? Where is that money coming from? Because we know the remaining amounts are going to come from whatever loan they've selected. Once they have applied for this type of loan they've committed to, and the down payment they've committed to, this financing contingency will survive if they have met all of those requirements. It will survive until it is waived or until it closes. Now, within these first 5 days, it gives the buyer an opportunity to make this application. So in the first 5 days, the buyer can change the lender of who they're using for the funding for this. However, they do not have the freedom to change the type of loan because the type of loan was already signed off and approved when this form became mutual. Financing can be waived. There are a couple ways it can. So this is how you want to make sure your buyers are really kind of following these rules and you are walking them along in a way that keeps that financing contingency protection under them. So the waiver of financing can be done if, one, the applying for the financing agreed, you can retain it by the applying for the proper financing and loan type. It will stay protected with them if they are truly denied for the type that they have applied for while providing all the documents they need to do. And then having a lender letter that proves that the requirements were met to make this application and that they've made a good faith effort in a timely manner. Paragraph B actually bullet points the ways it can be waived. So if the buyer fails to make application, changes the loan type without the seller consent, if the buyer changes lenders after the 5 days, unless it's changed to something different, or if they've also just decided to waive it under the automatic waiver of financing. Ways that it can be waived. Like I said, there are ways that this can definitely be waived. So buyers and sellers, keep these things in mind. You can waive it by giving notice if you are a seller with the 22 AR. That will be done after the specific number of days listed in paragraph 2B. And that notice can be given, and then the buyer can choose to sign it or face consequences if they don't sign it. You can have an automatic waiver of the financing, which we'll talk about in paragraph 2B. There could be a waiver of the contingency based on a breach. So if they have failed to do one of the items above, it will be an automatic waiver of this protection. If an appraisal comes in low and they choose to proceed, there is a waiver of financing. And again, if they change lenders after the date allowed without consent, or at any time along the way, change the loan type without consent. So paragraph 2B, or 2A and 2B. These two selections are two different ways that this financing contingency can kind of be taken away. Now think about this in a broader perspective. All of our forms along the whole contract give the buyer the opportunity to discover things, to do their due diligence, right? We have our inspection contingency that gives the buyer that opportunity to decide if they want to move forward. And in every single one of our other forms, we have an end date. So 2A, the seller's notice to perform, is the buyer saying, okay, seller, I am going to make application. I'm going to do everything that I said I was going to do based in this contract. And after 21 days, I am going to be opening myself up to the possibility that you may ask me to remove the protection of my financing contingency. If you have a box checked in 2A, as a seller or seller's agent, we want to make sure that we are notifying that seller and giving them the option to ask the buyer to remove their financing contingency or not. This is a choice that the seller gets to make. It doesn't just let the sale fall apart completely. So if you're afraid to give notice, we can talk about ways that we can give notice. But what it's saying is, buyer, after 21 days, you should be confident in your financing. We should, at this point, already have an approval. They should have been given the disclosure. They would know what their monthly payment is going to be. They would have their down payment ready to go unless it's another contingent source of funds. And all of those things should be lined up in a way that there should be confidence that that buyer is going to close. The way we create the confidence for that seller is to tell that seller, okay, I'm ready to remove the protection of the financing because everything has been done and I've been approved. I will talk in another class about how to serve that notice with the 22AR. But if you would like your buyer to waive financing, the 22AR can be delivered anytime on that date or afterwards. It doesn't have to be delivered right on that date, but at the very least on that date or before that date, have a conversation with your seller about what it means for that buyer to continue forward with that safety net. You do have the option of either selecting will or will not waive appraisal. Now, a financing approval and appraisal are not the same. I'm going to talk about that in a later slide as well. But I wanted to go also to paragraph 2B. If we are in a competitive situation and we want to give as much confidence to that seller as possible, I've seen people waiving inspection and waiving this and waiving that. This is probably one of the strongest ways that you can waive something. And, it's almost more effective, I think, to me than waiving just an inspection. Because what you're saying is in paragraph 2B, seller, you don't need to give notice. I'm telling you that on day, say 21, the protection of my financing contingency will be removed and we will move forward to close without any further action. Again, we can do will or will not include the waiver of the appraisal. So the financing contingency and the appraisal provision are completely separate thoughts in this. I don't want the waiver of financing to trigger any thoughts that they are just going to be out all their earnest money if that appraisal comes in low. As long as you have selected it will not waive appraisal, then should a low appraisal come in, the buyer still does have protection for their earnest money. So with that in mind, waiving the financing simply just means waiving the approval to be financed. And if you selected will not waive appraisal, you still hold that protection that whatever the bank's final say is on the value of that appraisal, or even if it should come in at value with conditions, even in a low appraisal, you still have the opportunity to let the buyer kind of keep in the game, and to, at the end of the day, if the bank cannot make this work, you still have that protection and getting the earnest money back. This is an option for either an automatic appraisal or automatic waiver of financing, or triggering a seller to make action on that. Now, the one time it won't protect you is if you click will. If you are clicking will waive appraisal, what you're saying is, I don't care what that bank says, I'm buying this house no matter what, and we'll just waive everything and move towards closing. That completely removes the safety net, including appraisal. So be very careful on how you select bullet points 2 and 3 when you are waiving financing or even having the option there. I've seen a couple appraisals over the last 30 to 60 days come in a little bit low. And even if the financing at that point was waived, that buyer would still be protected with this appraisal provision. Bullet point 3, loan cost provision. So these are closing costs. Now, every loan is different. Different loans allow a different amount of money to go towards the buyer's closing costs. You could put in $100,000 here. And if the buyer's loan only allows $3,000, then that's all the buyer will be allowed to put towards their closing costs. So remember, there is a maximum. And on our Facebook page, we do have a sheet that lays out what the maximum allowed is for a buyer to receive as credit towards closing costs. Keep in mind too, if you're working with a VA buyer, it is prohibited for them to pay commission. So there's going to have to be some sort of negotiation around that. The buyer is also prohibited to pay certain types of closing costs. And all that means is they can't roll it into the loan. So you may see some negotiation in this paragraph when you have a VA buyer. There's also a fee that goes along with VA and certain other loans. It looks like VA, USDA, and FHA loans. It's just going to show up on the closing statement. So just keep these things in mind when you are filling in the blanks for here. The earnest money paragraph lays out how the buyer retains their earnest money by using the financing contingency. So in order for the buyer to recover the earnest money under the financing contingency, the buyer must provide the application was made before the deadline in paragraph 1. They have to have been given loan statements, and the date has to be prior to the deadline of the application. The buyer must have had all sufficient funds to close the sale. So if they said they were going to put $100,000 down and that $100,000 was a gift that they never got, there is no protection for that. They must have already had the funds available to close the sale. And then finally, it must contain the reason for the buyer's denial. So what happens when you get a low appraisal? What does it mean? How long does the seller have to respond? How do you do all of this? How long does the buyer have to respond? And what happens if the buyer just does nothing? Well, this is a paragraph that I think a lot of people glance through because we just don't see it very much. It may be something that comes up more often as we get into a more competitive market and the appraisers, are kind of lagging. When they do the appraisal, they can only look at the sales that have closed. So as soon as our market starts increasing again, we're going to potentially see low appraisals. Now, we know that we can ask a buyer in a contract to add additional down payments. There's forms to do that. But in the event that that hasn't happened, and now we are faced with a low appraisal, there are a few options on how you can respond to that. I'm just going to talk about the idea that you're going to respond. And then there are a few situations where you may choose not to respond to this. If you get a low appraisal, the appraisal needs to be sent into that seller within 3 days of receiving it. So you get the appraisal, you send in the notice, which is a 22AN, and check the box that says the appraisal came in low. Now, on that form, there's nothing that says the back and forth times. There's nothing that says on that form how long the seller has to respond, how long the buyer has to respond back. It's all going to reference this financing contingency. So with that thought, if you don't have a financing contingency or at least an appraisal contingency, then you have no right to put in a notice of low appraisal or even negotiate it at that point. Once that seller receives the notice of low appraisal, they have 10 days to decide what they're going to do about it. So this timing, keep in mind, you may have to extend closing to figure out how this is going to work. I've seen appraisals come back pretty quickly, and even with these timelines have been able to close on time or even early. But the first response the seller has a choice for is a reappraisal or reconsideration of value. Now, this is done at the seller's expense by the same appraiser or another one that's acceptable by the lender. And what they are going to try to do is bring the value up to the purchase price. If that's done, then the final say is from that lender if they would be willing to accept that low appraisal, or sorry, the reappraisal. And if they choose to accept it, you can move forward based on that choice. The second choice the seller has is to reduce the purchase price and try to come to some sort of an agreement. Keep in mind too that there are going to be amendatory clauses for certain loan types. FHA and VA, I know for sure, have amendatory clauses that basically at the end of the day say, no matter how you are in this whole negotiation, buyer, you have an out if you choose not to purchase the house if we don't believe the value is there. So the seller and the buyer can come to an agreement of some sort of price in the middle. They can reduce the price to the amount of the appraisal, or the seller can just flat out say, I don't care. This is not happening. I'm going to reject this. So within those 10 days, the seller is going to give one of those responses. Once that seller gives the response, the buyer has a chance. Let's go to my next slide. The buyer has a chance to decide how they're going to respond to that. So the buyer has 3 days. It's decided in the Form 22A, all these timelines. They have 3 days to respond to how they want to handle this. They can choose to accept this new price. They can choose to accept the reappraisal. They can consent to a price in the middle. They can consent to the price, of the appraisal. Whatever happens from that point, if the buyer chooses to move forward, they are doing so without financing contingency protection because the financing contingency already protected them to this point. So the financing contingency has done its job. And if we have decided to go based on the appraisal, then everything lines up and the seller can move forward with the confidence that the buyer will be closing. If the buyer rejects any of these things, the buyer is entitled to their earnest money. Now, this is whether the financing contingency itself has been waived or not. So there may be times where a buyer doesn't want to give the notice. think about why a buyer would choose not to give the notice. Say the appraisal comes in $3,000 less, okay? And the buyer's like, I can come to the table with $3,000. Let me see if I can pull it together. By doing that, they are not giving notice to the seller, and at the end of the day, not waiving their financing contingency while they try to pull everything together to get this to close. Now, if they happen to not be able to close, even if they can't pull it together and still retain their financing, then they still have the protection of their earnest money. A buyer may want to give notice if there is a big gap in this price versus appraised value, and it's unrealistic to come to the table with that much money. Reappraisals and reconsiderations of value have been successful. So it is possible that both buyer and seller could benefit by choosing one of those options. In each situation, you're going to have to figure out what works best for your client. At the end of the day, when it comes down to the appraisal, once you've given notice, you have two options. You can either waive the financing contingency, or the buyer can walk away with their earnest money. If the buyer chooses to take no action after they've given notice, so they have to have given the 22AN for the low appraisal, sellers responding with however they choose to respond, and buyer just doesn't respond, then the default in our contracts say that there's an automatic termination of the purchase and sale agreement, and the earnest money goes back to the buyer. And if you think about this in the big picture again, that is because the financing contingency survives. So if the buyer can't get everything together and close, then everything is terminated on that third day, and earnest money is awarded to buyer. If you intend on closing the sale and you've given notice, make sure that you do respond, because like I said, there is an automatic termination, and you don't necessarily want to let that fall out of contract if everybody's intention is to close. Now, appraisals have come in with work orders. This paragraph right here, right below this appraisal, back and forth, does talk about how the seller, by signing this form, is pre-authorizing that lender to come in and conduct any inspections they need. There is no limit to the inspections that lender can do. They can do well, they can do heating, they can do plumbing, they can do septic, they can do anything they need to get all the information to fund this sale. Now, the seller doesn't have to pay for these things. They just need to allow them to happen. And if all these inspections are done and the appraisal comes in and there is what they call a work order, or how we've heard it in the past is conditions. If there are conditions on this appraisal to come in at value, then the buyer will be notified by that lender or the appraiser. Now, if that buyer wants to make this close, they need to provide the seller a proof of this, the things that were called out within 3 days of receiving that. They're going to be sending over a 22AWO, which is appraisal work order, and attach the things that need to be done. Now, there is no obligation for that seller to do anything on that list. And there is no obligation for the buyer to do anything on that list. What it is a list of the conditions the appraiser needs in order to fund the loan. So this is going to be another time where we need to have good communication skills, good negotiation skills, and figure out how to make this deal work if there are conditions that get called out. Now, for these inspections, technically, the buyer is allowed to attend the lender required inspections if they choose. I haven't seen it happen much because usually a lender doesn't give a lot of notice for things like that. And if they do, a lot of times these things are just called out by the appraiser. So any work orders, again, like I said, must be shared within 3 days if, in order to pull these together, right? The conditions do protect the appraisal provision on the financing contingency. So even if it comes in at value, if it has work orders called out and nobody gets them done, the buyer's earnest money is protected if the sale should fail to close. Now, we do know that FHA, VA, and USDA all have kind of their own set of rules. And one of those rules is that those lending programs don't require a buyer to purchase a property if it does not appraise. So you will see what they call it, like an amendatory clause. And we've added it into our 22A because every time it came through, it just kind of triggered questions. It is actually just something that is required by the VA. So we do have the amendatory clauses added into our form. Your seller or buyer or both and agents may be required to sign an additional copy of this, but what you're signing is paragraph 7. And there's always this extension of closing that has not changed. That just gives that buyer a peace of mind when it comes to making sure that they've been given proper disclosures on all of their loan information and extending if necessary to accommodate for things like rate changes or anything that a lender needs to redisclose to them. So including the 22A automatically consents the seller to complying to the VA and FHA mandatory clauses and regulations. And like I said, the lender may also require this verbiage to be signed separately. As we think about our contracts, we can think about them in a 2-part piece. So the contracts we put together are contracts between buyer and seller with instructions to escrow on how to execute the contract. We do have a third party though. We deal with lenders. So sometimes the lenders need something of their own as additional instruction or additional consent. So there's some situations that I was thinking about, and I just wanted to put them out there for you to think about. And I will just kind of list these questions and then talk about how those answers work. So think about what happens if a buyer applies for financing late? Does the seller have any rights? What about a buyer getting denied? Do they have to notify a seller? What if the buyer's interest rate goes up and they no longer want to purchase the home? What if a buyer chooses to use cash instead of financing after using a 22A in the offer? And what about a pre-approval from a lender? Maybe they have a lender A that they've been pre-approved, and before the 5th day, they decide to go with a different lender. Do they need consent? And what happens if a buyer applies for financing but uses a smaller down payment than what's on the 22A? Is their financing contingency waived or still intact? So for buyers who apply for financing late, does the seller have any right to terminate? Well, no. This is just a contingency protection, right? So the seller doesn't have any rights if the buyer applies late. The consequence to the buyer, however, is the waiver of that protection. So they didn't do what they said they'd do. The consequence is buyer no longer has the protection of that contingency or anything in it. If a buyer gets denied, do they have to notify the seller? There is no requirement right now to notify a seller if the loan is denied. The financing contingency will protect that buyer if they have applied as they promised in the addendum. And the buyer may give notice or they may continue to attempt to close the sale in another way. This one is tricky though, because at the end of the day, at the end of the sale, if they cannot close it and they've done all the things they need to get the financing protection, they would be entitled to their earnest money. The buyer's interest rate goes up and they no longer want to purchase. So the fact that the buyer's rate has changed, it does not excuse them from moving forward on that financing. And if they were approved at the rate, then they are not free to just terminate because they don't like the rate. I want to add one more thing too. As sellers, we now have an open communication ability. We no longer have to wait like we used to contact a lender to find out information about how that loan is going. So we should be all along the way finding out things like all of these questions. These should not come as surprises to us. What if the buyer chooses to use cash instead of financing after using the 22A in their offer? Well, the buyer can change their mind and use cash. The buyer also, though, has to apply for the financing they agreed to if they want the continued protection of that contingency. If they don't want the protection, then go ahead and use cash. The financing contingency is waived if they don't follow the rules they said they were going to follow. If a buyer has a pre-approval letter from lender A and then switches before the 5th day of mutual acceptance to lender B, does the seller need consent? No. A buyer can switch lenders within those first 5 days with no consequence. They need to, though, by that 5th day, have their full application made, all their paperwork submitted, tax documents, bank statements, and have a disclosure from that lender. So it doesn't matter if they switch. However, they need to be on it as far as getting all the documents in and proving that they made full application, including the home address, before the 5th day or on the 5th day. And what if the buyer applies for financing with a smaller down payment than the 22A? Is the financing contingency waived or still intact? Well, technically it's waived. The buyer didn't do the things they agreed to on the 22A. So they can't keep the protection of what they promised to do by not completing their part of it. So when you get, as a seller or even a buyer's agent, when you get your buyer approved by that 5th day, everybody should be looking to make sure that financing type, the down payment, and the timing was met. Now, if for some reason it just isn't going to go through, and you need to terminate because the financing just couldn't happen, we do have a financing notice. So the only thing I wanted to bring up with this form is make sure you're not using a form like a rescission. We don't want to use like a 52 where it requires a buyer and seller's signature for that buyer to get out of this. If that buyer has truly done everything they are supposed to based on the financing contingency and cannot get approved, the proper notice is going to be a 90I. But in this, you also want to make sure you're attaching the lender letter that proves they've done everything they were supposed to do. Again, do not rescind. Make sure you terminate if there's a right.